Hello and welcome to Market Outlook by MarketGauge. This is Jeff Fish, President of MarketGauge, filling in for Keith Schneider this week. And I'm going to look out at the markets looking forward for the week of April 27th. So last week we ended on a rather interesting note in both domestic and global markets. And as you look at my screen here, you'll see in this video I am going to cover both the outlook domestically as well as internationally, because we've got a lot of interesting things going on internationally. And so, look no further than the SPYs trying to break out on a weekly basis, the NASDAQ breaking new records, all-time highs, as I'm sure you can't have missed in the media this week, and bonds bumping their head up against major resistance and maybe even looking lower. So we've got a lot to cover here, but before I do, if you're watching this on YouTube, make sure that you also check us out at marketgauge.com/tutorials for a lot of additional information that you can get for free. And also, if you're not already aware and your video is not showing in high definition, you can use this little settings icon down here at the lower right in the controls, and you can switch it to HD and the image will be a lot clearer. All right, so with that, let's get started. Let's start domestically. And the way I usually look at that is to take the SPYs in the upper left, the Qs in the upper right. I'm looking at weeklies right now. I'm going to put the TLTs rather than the Dow in the lower left here, and I'm going to put the IWM, the Russell, in the lower right. And here's the big picture. SPYs unable, or I should say haven't yet broken out of their weekly or really monthly consolidation period near the highs, but the Qs had a really strong week last week, driven by earnings, and some of the bigger cap names in the index really broke out to new highs. And so the question we want to look at is whether or not this is a concerning divergence with the Qs breaking out. IWMs, if we look down here, I'm showing you on the weekly because there's some interesting weekly patterns. Weekly has not broken out yet, and the SPYs haven't broken out. So should we be concerned about that? I'm going to touch on each one quickly in the bigger picture. SPYs, I think you can see the compression here until we break down from this trend line in a significant way. And I look at this on the daily chart as well. If we're not trading below the prior week, if we don't close below the prior week, right now I think you've got to take the stance that we're in a bullish mode and look for maybe some choppy action. But if you've got an index leading like we do in the Qs, the assumption right now should be up. That doesn't mean it's going to be straight up, but this is a pretty strong breakout on the Qs on the weekly basis. And so when do we look for that to have failed? Let's say it is a divergence and it's a head fake. Well, if we get back down below these highs in here in a meaningful way, and then you've got the SPYs lower and the IWMs lower, then you can worry about it. Until then, any pullback to here is just a healthy pullback. And you'll see when we look at equities internationally are strong as well. So rather than drive yourself nuts with all the crazy fluctuations, focus on the big picture. The big picture is up. We may see some pullbacks. Use them as opportunities and step out of the way if you don't want more exposure. And the other reason that I say that is because of the big picture on the IWMs. Right, so the IWMs broke out earlier this year, essentially from a year-long consolidation. Now, you're probably tired of us telling you this, but if you're new to the market gauge view here, this is an important dynamic in trying to figure out what the overall markets are going to do. IWM's broadest measure has been strong. It has not broken out again, but keeping in mind where it is relative to the other ones, it's already running ahead. So let's not worry about the Q's divergence until, again, we see really, really weak performance in IWMs. And the other pattern I wanted to point out in the IWMs is just look at how, and this is typical of markets in general that are in strong trends. IWM had a really nice channel from the beginning of 2013 up to 2014. Now the rest of the markets continued in an upward fashion, but then it rested. It rested for a year, and if you take the big picture view, it rested in a rather nice way. And not only that, it consolidated really nicely here, and now it's in another channel heading higher. So until we take that channel out on the downside, which will roughly equate to breaking the 50 and continuing lower after that, look at it as a bull market that just may not be as easy as it was in 2013. So that should probably have you saying, well, yeah, but what about interest rates? So let's take a look at the TLTs for a second. TLTs, I do have to admit, look like they may have topped out. Now, the reason that I would say that is because it's having trouble, TLTs having trouble getting back up above this 103 and a quarter level. And that comes after a almost parabolic move to the upside. So this very much looks like a blow off top, and I wouldn't say that were it not for the fact, well, I would say that, but I wouldn't give up on the fact that we've got negative rates in a lot of the world. So to say that our rates can't go any lower, I think is just not an assumption you should make. But you got to let the markets tell you what they want to do. So when the markets can't get back up above this resistance level and start to roll over, then I do start to think that maybe this is it. That said, big picture in rates is that they are stuck, or TLTs are stuck between this very good support, and it may have gotten overextended on the downside here, and this very significant resistance. So choppy action in here, I don't think really should have a whole lot of bearing on the equity prices. If anything, maybe even a constructive or a controlled move lower could let the equity markets think that the economy actually is holding up better. In my last week's version of Outlook, however, I pointed out there's been a lot of negative surprises on the economic front. So the markets are going to be a little bit worried about the health of the economy. Lower rates may be telling you that the news flow has the markets thinking the economy is strengthening. If that happens, that points to further rises in equities with a healthy decline in rates. So that said, I conclude as far as what you have to focus on with rates or TLTs, as long as they're stuck in this range, as long as they don't do anything really dramatic, I wouldn't let them dictate what you think about stocks. And if you wanted to trade rates from the short side, meaning you think rates are going to go up, this is the level to be selling against. And a breakdown, if we just take a look at, I'll take a look at the daily chart here because it's got a really interesting level on the daily. There we go. Okay, so I know I got a lot of lines here, but these are the same lines. The key level here and the key action for this week is that this is the 50-day moving average, which, the magenta, which if we take a look at the market just from a 50-day moving average point of view, nice, this is that big run up, breaks the 50, can't get through it, makes a new leg down. You could say that it got back up through it, which technically it did, but essentially this last attempt to break the 50 has been unsuccessful. And this week, last week, it broke down pretty hard. Now it's rallying back up to the 50, which from my perspective, the 50 is really now this trend line. So this whole area in here is resistance around the 50. So if it rallies up into this area and rolls over, what it's really done is broken the 50 in a big way, unable to get back through it, and broken it again. Big picture, that's a very toppy formation. The gray line you see there is the 200, which will line up really nicely with this low in here. What I just pointed out on the weekly chart was this range, but an expansion to the downside will really just expand that range down to the 122 level. All right, and I would say the same thing. Rates between, or TLTs between 132 and 122, I think are probably healthy for stocks. Day to day, probably will shake things up a little bit, but bigger picture, I think that's what it looks like. Now, while we're on the topic of TLTs, let's go over to UUP and then we'll look at the breadth. Right, so here's UUP, which is the dollar index, and here's the TLT, right, which we were just talking about. And I'll try and get these lined up relatively close. Should have done this ahead of time. All right. So you'll notice that in the March time frame, or I should say this low here, and I guess I can do this. Just to get these to line up. All right, so you'll notice that with this line, as TLTs were getting weak, rates are going up. It's got a really positive effect on the dollar. Now, rates have kind of stabilized here, and the dollar has also stabilized. Now, the news will still tell you that it's strong. It is still extremely strong. The trend here is still pretty bullish, but one way to play the rates going down, up, TLTs going down, might be to look for another resurgence in dollar strength. That said, dollar is at a really interesting level here. Here's the 50. So I would look at the dollar kind of like this. And if it breaks higher, there's probably an opportunity there. The opportunity would be even more compelling if we see it happening at the same time that the TLTs are moving lower. Now, if we look at the dollar, and I'll probably do this a little later, the dollar relative to what the SPYs have been doing, it does kind of correlate pretty nicely with a stronger dollar, putting a little pressure on the stocks. With earnings season more than halfway through, maybe this will abate. It was definitely a concern in the earnings season that a higher dollar would drag down earnings, and plenty of companies have complained about it. That said, stronger dollar can also happen with stronger stocks. Totally depends on the mood of the market. Going into earnings, it was kind of a negative mood. With earnings behind us, the stocks might be willing to forgive it, figuring next earnings season is too far off. We're not going to worry about it. Now, that said, keep an eye on the dollar. Keep an eye on if it breaks down here. That would be a major change from the trend in the dollar. As we take this out, right? It's been an incredible trend, and from this perspective, the dollar could really afford to sell off quite a bit and still be in a pretty strong trend. If the dollar sells off, stocks could really use that as an excuse. You know, the bulls are going to say, "Oh, dollar's selling off, great. We can buy stocks." Keep an eye on it. It's at an inflection point. All right. With that said, let's just take a look at the breadth in the market. All right, so in other words, let's just take a look at what's going on internally in the market in the way that we do each week, just to get a sense of whether or not we're at key inflection points. Right. So here's the McClellan. McClellan is a measure of breadth. You got the SPYs, or the S&P 500 cash up top, so you can see trying to break out here. You would think that after all this move upwards, that maybe we would have a little bit of a overbought situation, and we are nowhere near it. All right, so McClellan right in the middle of this range is not overbought. It's not oversold. In some respects, it's almost a little nerve-wracking that it's demonstrating that we're creeping up, but internally the market's not, it hasn't been a broad rally. And so just because this isn't overbought doesn't mean that we can't sell off from here. I don't want to be overly negative, but if we get negative price action against these highs and the breath starts to get really weak, that could be a warning that the market is weaker internally than we'd like it to be. What we want to see, what I want to see, is I want to see the market make a new high, and I want to see this actually get overbought. Not because I want the market to get overbought and roll over, but because I want to see the breadth really push to the upside. Right now, it's kind of in the middle of nowhere. I'm not going to draw any conclusions. I'm just going to look for it to confirm a move higher. All right. Now, if we look at a really simple measure of breadth, just advances, declines, added, and subtracted together, again, you're not getting a lot of indication that it's overbought there, but the reason I look at this chart is for the volume. So this is up-down volume on a 5-day basis, the ratio, and it's the same thing. We're pushing up towards the highs. We're definitely not overbought. So a push to new highs and a volume surge would really be constructive at this point. Now, part of the reason that I'd like to see that get overbought is because the same thing's happening in the new highs, new lows. So here's a look at the new high, new low ratio, which you can also see on our little Big View Market Internals website. And up top is the total number of new highs and new lows. So what I've done here is I've just drawn a red line at 150. And so the blue line here is new highs. And actually, for those of you, let me just change the color of this one. It might make it easier. I guess that's not going to be as easy as I thought. So the blue line, the darker line, is the total number of new highs. Now, this is a very volatile number, so you don't want to get carried away with it. But if the market breaks out to new highs, this should be over 150. In strong moves that are going to continue, you'll typically see this over 150. So if the market breaks out, just look at the total number of new highs and see if we're consistently getting 150. So if I look back in time, just to give you a sense of this, all right, when we had a really strong trend back here in 2013, you can see this is the red line, all right? You can see we have really good numbers, total numbers of total new highs, all right? It's volatile, right? It's volatile, but when the market takes off here, nice breakout into new highs. Market takes off in here, nice breakout of new highs. So the market tried to break out here. You got a nice breakout, but immediately came back down. That's not what you want to see. The breakout, lots of new highs in here, but the market didn't continue. All right, so you want to see both of these things go together. And if we continue to move higher without this breakout, that's going to be a heads up. All right, definitely heads up that something is not right. The market's just too narrow. Narrow markets can have really nice moves, but they generally don't last very long. All right, so here's the same data on the Qs, and it's the same exact situation. In this case, the red line, easier to see, is new lows. Same thing. We got to get over 150 consistently if the market breaks out to new highs. If it doesn't, then you're really going to want to be protective. All right, now finally, the interesting thing here about the markets near the highs, now this, as you saw, the Qs have really broken out. The NASDAQ composite also broken out. So you'd think there'd be a little bit more exuberance in the market, and just based on the VIX, and I realize this is not the VIX on the NASDAQ, but based on the VIX here, it really hasn't pushed or punched a lot lower. So I don't see any kind of indication here of an obvious immediate top. Now, this is a very short-term indicator. We like to see this come through the Bollinger Band on the downside, just indicating that it's too much complacency. Right now, yes, the VIX is low, but in terms of looking at the next couple of days, timing-wise, nothing here that indicates a warning sign. So if I add up just these really simple measures of the breadth's not overbought. If we get a push to the upside, it would be nice to see it overbought. If we start to roll over in the markets, you got to watch out for the breadth to get really weak, because markets can really fall apart from weak breadth markets. But that really should take an entire week to develop, so we can't make any assumptions from that right now. So one last area domestically is, let's just take a look at some of the sectors that are at interesting spots. Okay, now if I go just to our little big view area here, I'll show you an easy way to do this. All right, so I'm just in little big view, which you can get from resources, little big view, and I'm just going to go to sector summary. And so with the SPYs about to break out, with the Qs breaking out, the thing that I wanted to look at was, well, how are sectors really supporting this? And which sectors might be supporting it. So I've shortcutted it a little bit. I take a look at what's strong over the last 6 months. How are things doing year to date? Are those sectors still pushing higher? You can see that we have the phases right here, and so warning means you're under the 50. That's not really what I would expect with the SPYs pushing new highs. We still have 1, 2, 3, 4, 5, 6, 7, and recovery is coming back over the 50. So let's call it 7 of what is probably about 12 major sectors are still under the 50-day moving average. Now, you could look at that and say, well, that if it comes back over the 50, that leaves plenty of room to the upside. But this supports what we just saw in the new highs. It supports what we see in the breadth, which is SPYs might be pushing new highs, but there aren't many areas of the market that are pushing those new highs. In fact, much of it is still under the 50. So we want to be careful looking forward, again, out more than a week, to see that any rally broadens out. And I'd be focused on stuff that's coming back over the 50 in a good way, but more so, let's focus on some of the stuff that is already strong. So some of the sectors you might want to pay attention to immediately from a bullish perspective are the following. And I'm going to take a look at them in a chart where you can see how they are relative to the SPY. So I got the SPY on the bottom, and one of the only sectors that's really breaking out to new highs is the XLY, the consumer discretionary. Right, so that would make sense if you're following the stream of logic that rates have pulled back because the economy belief the economy might actually be getting stronger, and XLY, consumer discretionary, would be a good place to look for enthusiasm for stocks related to the economy. So this is good. This is what we want to see in terms of the market moving higher. We want the market to be moving higher because it believes the economy is recovering, not because it believes that the Fed is going to save the day with interest rates, because we know that's not going to happen. So XLY is definitely one to watch for opportunities on the upside. Also one to watch as a bellwether, right? If this falls back into this breakout, heads up, because as we look at these other indexes or sectors, you're going to see none of them are breaking out to new highs. Now, I went to XLV, but my natural next step would have been XRT, right? Retail, because that's kind of a subsection of consumer discretionary. Retail's been strong, and so relative to where it started in the new year, it's strong and probably outperforming the SPYs, and in fact it is by a fraction. I'm looking over on my other screen at that sector summary. This is up 5% versus SPYs being up about 3%. So slightly outperforming, but what you can see here in this chart is we've got the XRT here, retail, made a new high at a point where the SPYs were selling off. So this is a healthy correction back to its 50. Another place I would look. If markets are healthy, XRT, retail, looks like a good place to be. Now the other place that looks like a good place to be is healthcare. And so that's XLV. Kind of similar situation to what I just described with XRT. You can see that when SPYs struggled last time, couldn't get back above their highs, healthcare made a new high. And while it's not back at the new highs here, it's beating its March highs. This is kind of the line you want to see it hold, which it has held. So this got a little bit of ahead of itself, but now the consolidation is set up nicely. So if markets go higher, XLV looks good. Same thing could be said about IBB. This is biotech. Now you could look at this and say that got way ahead of itself, but a correction back to the 50. Keep an eye on this one. Technically, this is the area where if it was going to fail, this is where it would fail from. But if it continues to move higher, I wouldn't let one big red candle that has already sold off stop me from taking advantage of another move higher in that particular index. Now XLK is technology, right? And we're going to see that in the Qs. I'll take a look at the Qs in a second. So not surprising that this one is moving higher. It hasn't broken its prior high here, but if you want to trade technology, you can trade the Qs and you'll be at new highs. For example, here are the Qs with really nice looking breakout. Apple reports earnings today, I believe, after the close. I'm doing this Monday morning. So it'll be interesting to see how the Qs hold up regardless of Apple's fluctuations after the earnings. And while it's not a major sector, one sector that I can't not point out is TAN. This is solar. It's been on a bit of a tear here. And right back up to this 50 level, which is an interesting level of resistance. So we get some consolidation here. It certainly looks like it's got the momentum to punch through the 50 level. But if it sells off, there's plenty of room for this to come back down to its 50-day moving average right here. Either way, it's definitely one to keep an eye on. Now, with the markets being strong, and if the economy is the driving force, then really IYT, the transportations, should also pick up. Now, from a technical point of view, this looks pretty nice. Bottom of the range, the gray line is the 200, falls back right on good support. That said, this is one of those indexes that's still under the 50-day moving average. It's not really what we want to see with the SPYs breaking out. So I'm keeping an eye on the IYTs. If you wanted to look at a kind of a cheaper, so to speak, way to bet that the markets are going to break out, IYTs might be the way to do it. But just like I said with the new highs, with the breadth, if markets are breaking out to new highs, we want to see this IYT pick up. All right, now, when we're, with an eye on both the economy and the sectors, let's take a look at energy. We can't really not talk about energy after crude's horrendous decline this year and end of last year. But crude's actually, USO, is at an interesting point here. If you take a look, all right, this 20 level represents a really good breakout of the base, right, after making a new low, and now it's back over the 50-day moving average. And even if all it did was go back to the 200, that's a huge move. All right, so consolidating right at that important 20 level, and so if it breaks out of that, keep an eye on it. And another way to play that would be OIH, which has already broken out of that base, holding at the 10. Again, if this continues higher, this is an interesting way to play a breakout in the stocks, especially if it's led in some ways by energy coming off its lows. XLE is also an interesting play there too, but notice XLE didn't really take out its level from early February in the same way that OIH did. All right, so one last relationship here terms of the economy is actually a stock, and it's FCX. So Freeport is often viewed as kind of the canary in the coal mine for the economy and for stocks. The relationship between stocks and this particular stock is not always perfect, but seeing Freeport get absolutely crushed would indicate a fear that the economy is going to get weaker, which can precipitate into declines in the stock. Now, like I said, it's not perfect, but notice some interesting correlations that have happened here. The decline in FCX ended right about the same time that the SPY's decline from this high ended. The bounce now in FCX held, which makes FCX look like it's bottoming. And so if FCX breaks out to the upside, one, it's an interesting looking stock right here, and SPYs break out, and maybe we're in sync with, hey, the economy is no longer the concern, but actually a positive for the markets. If you think what you want about the economy, I don't care. The only thing that matters is what the market seems to be reacting to. All right, so just another thing to keep an eye on. Now, all this said is happening in the context of very bullish action internationally. So I actually think that there's potentially even more opportunity internationally than we have domestically. But this supports what's going on domestically. So take a look. This is ACWI, the benchmark for global equity markets. Remember that pattern we had on IWMs? Well, this is essentially very similar pattern, only this is international stocks. And it's now breaking out in a big way. I say now, it's been happening for weeks. I've highlighted it in last videos that I've done. And last week, that breakout, as you can see, continued to the upside. Even if this thing sells off all the way back down to the 61 level, it's still going to look like a strong breakout. In fact, even if it comes down to the 50, it's going to look like a strong breakout. So big picture globally looks quite good. So let's just take a quick look at some international opportunities here. First of all, you probably cannot have avoided the fact that China completely exploded, not last week, but the week before, and it's held up. It's held up rather remarkably, and so I happen to think that that looks a little bit overdone right now, but after the consolidation, depending on their economy situation, that's a breakout that probably, that really does look like an indication of very longer term an opportunity to the upside. Pullbacks, I think, to be expected, but you've got China doing that, and here's the unhedged, or no, hedged view of Japan. All right, so Japan also very strong breakout this year, and it has just continued. So a pullback in Japan also looks interesting. Now, some other areas that look really interesting. Taiwan. Now, this is just breaking out last week, but China's breaking out for its own reasons, and some of them are stimulus and some of them are structural in the markets. So Taiwan's a different situation. This isn't just following China necessarily. So this is a awfully interesting breakout here. Pullback would still leave it with great opportunities. Pullback all the way to the 50. I don't know that today is the day. This week might not be the week, but longer term, this is a very powerful looking pattern. Now, this isn't Asia anymore, but Europe, right? More specifically, Germany. Really interesting pattern here. Again, the magenta on my charts is the 50. So this is the first time it's pulled back to the 50 after taking out the 200, and it's sitting right at what should be some pretty good support. Now, you've got a lot of resistance up in here, but if you wait for all that, by the time it gets up to 32, you're going to be feeling like you're overpaying. You're going to be worried about a double top. So this video isn't about how to get in, but it's certainly pointing out that looks like there's some good opportunities around here in Germany. Now, what about the weak part of Europe? A lot of Europe areas got literally negative rates, but in my opinion, Europe is where the U.S. was years ago. Finally, they figured out that they have to do absolutely whatever they can to stimulate the economies over there, and I think that is going to rise, not if not all boats, a lot of boats. Now, hard to talk about the situation in Europe without looking at Greece. This is highly speculative, obviously, based on the news flow, but this is a really interesting pattern here. I'm following it. I happen to think that regardless of the news, turn off the news, look at the weekly chart on Greece, if I can get it. I'm focused on the weekly chart in Greece. This $10 level here just seems like longer term a good place to be trying to position. And so from a daily perspective, therefore I'm watching it, we got a really interesting break below 10, an immediate rubber band effect right back up. Again, this is the 50. The 50 is now going to line up with a good breakout of what I would describe as a really nice looking double bottom right now. It's a little rich to be buying it up here. You're in the middle of no man's land, but buying against 10, looking for a breakout over the 50 and this base, I think looking forward is an opportunity, considering a breakout above 11.50, 12 could easily go to 16, and you're talking about a 30% move, I would say, easily. If it gets going. So some other markets that are not necessarily looking strong, but in really interesting places, longer term, and have bases. So here's Mexico, obviously crushed because of oil, but we just saw how oil's coming back, and now you can see pulled right back to the 50 in a nice way. If it gets back above this consolidation level, could really see a nice move up to the 200. Again, the pattern here is great. Timing wise, I can't give you that in this video. I'm already going way too long. But look for a move kind of like we just saw this week in Brazil, right? So Brazil, not the same exact picture, but a big flush down here. And again, let's look at the weekly quickly in Brazil, and you'll see why this is interesting. Down at major support from 09, okay? When I say I think there's huge opportunities internationally, there's several countries that are set up, if you look at the weekly charts, in really interesting places. Time your way in on the daily charts, and nice move back into a recovery phase here, and move higher. Now, I would say you missed it right now, but a pullback is the next pattern to look for there. Now, Russia. Definitely not a new trade here, but at an interesting, very interesting level. Not only that gray line, the 200, but maybe you remember this 20 to 19, or I should say 20, what is it, 21, basically down to 20 level as being significant. Looked like it was going to be double bottom there, and then it completely fell apart. Right, so this 20 level is going to be a big inflection point. This still looks like a total capitulation low, so pullbacks down into support I think are interesting, and a breakout of the 200 and back over the 20 level, 20 and a half. This high really is the one to focus on. 2070 could lead to, again, another opportunity to pick up something international at a great price longer term. Italy, all right, very interesting. Looks like we're going to have the 50 come back over the 200. I don't really care about that from a timing perspective, but it is a demonstration that the overall trends longer term are picking up. And again, look at the inflection point that this thing's sitting in. Nice correction right back to it. I know these things can gap a little, but you got to take a big picture of it. And if you do, there's tons of opportunity out there. All right, Austria. Again, nice base here, breaking out of the 200 and breaking out of the base. Take a look at the longer term picture. This thing is all the way back, coming back from lows not seen since 2012. All right, all that, relate that back to where I started. And I am going to wrap up here. Sorry this is so long. So I started with this look. We take a look at the SPYs. Will they break out? Right, this is daily. Maybe. Let's just go with the Qs up here. Have already broken out nicely. IWMs consolidating, but they're well on their way. And ACWI, the international, breaking out strong. So equities just they're not overbought, and that you can look at them as divergences, but unless they really roll over, it's going to take more than a week, I would suspect, for them to really roll over. You got to look longer term and say there's huge opportunities on the upside. Hope that helps. See you in the next video.